Hello everyone, my name is Mini Sethi. I hope you all are staying healthy. Today we are going to talk about fiscal functions, and we will also see center and state finance, especially for CA foundation. Fiscal functions means actions and responsibilities of government in order to manage a whole economy. Fiscal functions means actions and responsibilities of government in order to manage a whole economy. Richard Musgrave divided fiscal functions into three categories: allocation function, redistribution function, and stabilization function. First of all, one by one we discuss about each function. First is allocation function. As we know, our resources are limited. How to put these limited resources for the production of both goods, public as well as private goods. This function ensure we are using our limited resources in most efficient way. That means through this function, government use limited resources in such a way so that it can put these limited resources into optimal use. But how government allocate resources between private sector and the public sector, or we can say the state allocation. Allocation of resources in case of private sector depend on market demand, market supply and price mechanism. But allocation of resources in case of public sector depend on revenue and expenditure activities of government budgeting. But why there is misallocation of resources? Main cause of misallocation of resources is market failure. But why market fail? There are so many causes of market failure. First, imperfect competition and monopoly. As we know, monopoly charge higher price, that's why produce less output, and less output is main cause of misallocation of resources. Market fail to provide collective public goods such as defense. How market can provide public goods? Most of the player are private sector, and private sector operate for their own profit, not for welfare of society. That's why how they can provide public goods like free education, free hospitals, it is not possible for them. Incomplete market is not able to provide proper quantities of merit goods such as hospital and education. Externalities, negative externalities, main cause of market failure. Negative externality means when your activity generate loss for unrelated person. For example, you have factory, you are doing so much output and earning so much profit, but your factory is cause of environmental pollution. Because of you, society is facing loss. It will be called negative externality, and because of negative externality, market fail. Factor immobility, that means factors are not movable from one place to other place. It lead inefficiency and unemployment. Imperfect information, buyers and sellers don't have proper information about product. It also lead to market failure, and there is unequal distribution of income and wealth, which is also main cause of market failure. Now is instruments of allocation functions. That means what are the ways through which a government can contribute to proper allocation of resources. First is government can directly produce economic goods. Obviously, if more and more economic goods are produced by government, it would be beneficial for whole society. Government can influence allocation of resources by incentives and disincentives programs. For example, government can provide tax concession and subsidies for production of those goods which are beneficial for whole society, and can impose a higher taxes on the production of those goods which are harmful for society. For example, government can impose a higher taxes on the production of cigarette, on the production of alcohol. Government can also influence allocation of resources through its regulatory activities and legal frameworks. For example, licensing policy, control and act like Minimum Wage Act. Government can also influence allocation of resources through its competition and merger policies. Competition policies of government ensure there is fair competition and prevent a monopoly. And merger policies of government make rules and regulation for a combination of two or more companies. Next is a redistribution of function. This function ensure fair distribution of income and wealth. As we know, there is so much income gap between poor and rich. Through this function, government try to reduce these income inequalities. But how government can reduce these income inequality? By imposing taxes on rich people and use this tax income for welfare of poor people. Objective of this function are provide equality in income and wealth, provide security to people who have hardship, and ensure everyone is enjoying minimum standard of living. Now we will see examples through which government perform their redistribution function. Progressive taxation. Progressive taxes directly reduce income inequality, because progressive taxes means high tax rate on high income group and low tax rate on low income group. That's why progressive taxes directly reduce income inequality. Government can perform their redistribution functions by providing employment reservation, providing minimum wages and minimum support price for farmers for their output, providing unemployment benefit transfer payment, or giving monetary help to families below poverty line, and special schemes for backward regions. Next is a stabilization function. This is one of key function of government which aim to eliminate macroeconomics fluctuation. Stabilization function is one of key function of government which aim to eliminate macroeconomics fluctuations. As we know, there are so many fluctuation at macro level. For example, fluctuation in employment, fluctuation in prices, recession, depression, etc. And the main aim of stabilization function to eliminate all these fluctuations. And stabilization functions work for labor employment, capital utilization, output, income generation, most important, maintaining price stability and economic growth. But how government perform their stabilization function? Government perform their stabilization function through monetary policy and fiscal policy. Monetary policy means control money supply, control interest rate, control prices. Fiscal policy means government uses its revenue and expenditure programs in such a way so that it can produce positive impact on national income, production and employment. And through monetary policy and fiscal policy, government uses its stabilization function. Now we will see center and state of finance. Center and state of finance mainly describe financial relationship between central and state government according to constitution. Center and state finance mainly describe financial relationship between central government and state government according to constitution. Article 246 of Indian Constitution define power of union and state government by dividing into three lists. Union government means center government. Article 246 of Indian Constitution define power of union and state government by dividing into three lists: union list, a state list and concurrent list. Union list consists matters which are handled by central government. State list consists matter which are handled by state government, and concurrent list consists matter which is handled by both government, center as well as state. Now we will see taxes which are imposed by union government, or we can say the taxes which are imposed by central government. Central government impose tax on income other than agricultural income, because tax on agricultural income is imposed by state government and not a central government. So central government impose tax on income but other than agricultural income. Central government impose custom and export duties. Custom duties means taxes paid by importer. Export duties means tax paid by exporter. Central government impose excise duties on certain goods. Excise duties means tax imposed on goods which are produced within our country. Corporation tax. Corporation tax means tax on profit of businesses which is imposed by central government. Central government impose tax on capital value of asset excluding agricultural land. Tax on capital value of asset means whenever you sell your capital, you earn some income, and tax on this income is collected by central government but excluding agricultural land, because this matter is handled by state government. Tax on security transaction imposed by central government. Tax on security transaction means tax on sale and purchase of share bond, and central government also collect central GST. Central government also collect terminal tax. Terminal tax means your final payment after applying for a return. Now we will see taxes imposed by state government. State government impose taxes on agricultural income. State government impose taxes on land and building. State government also impose taxes on mineral rights. Mineral rights are given to company or individual who extract, drill mineral from land. In return, government charge some fee or taxes, and these taxes are imposed by state government. State government impose taxes on electricity vehicles. State government impose toll tax, profession tax. State government collect land revenue, impose some excise duties, and state government also impose stamp duties. Stamp duties means taxes on legal documents. Now we will see very important articles of constitution which define financial relationship between state and central government. First is Article 268. Article 268 deal with the duties which are levied by union, or we can say the central government, but collected by state government. Article 268 deal with duties which are levied by union government but collected by state government. For example, stamp duty which is levied by union government but collected by state government. Next is Article 269. Article 269 deal with the taxes which is levied by union government, collected by union government, but assigned and distributed to state. For example, taxes on sales or purchase of goods in case of interstate trade. This tax is levied by union government, collected by union government, but after collected this tax, union government distribute this collect to state. Article 270. Article 270 deal with the taxes which are levied by union government, collected by union government, but distributed between both state government as well as union government. For example, income tax. Income tax levied by union government, collected by union government, but this tax distributed among both union government as well as state government. Next is Article 275. Article 275 deals with grants from union to certain state. Article 275 deals with grants from union to certain state. That means central government should provide a monetary help or financial assistance to state government whenever they need. So this is all about fiscal functions. I think you got it, and thank you so much for watching this video. Bye. Take care.